Welcome to HouseLux Estate, your trusted channel for all things real estate and investment. Today's topic is a critical aspect of investing: how to analyze market liquidity in real time. HouseLux Estate is committed to providing you with the most accurate and up-to-date information to make informed investment decisions. This video will guide you through the key concepts and steps to understand and analyze market liquidity in real time. Join us on this insightful journey as we break down this complex topic into easy-to-understand steps. Before we delve into the heart of the matter, it is essential to understand what market liquidity is. Market liquidity, in simple terms, is the ability to buy or sell an asset without causing a significant change in its price. It's like a smooth highway where you can easily drive your investment vehicle without encountering traffic jams or potholes. In the world of real estate, it refers to how quickly a property can be sold without affecting its market value. This is crucial for investors, as high market liquidity means that assets can be quickly converted into cash. It's like being able to sell your car in a jiffy, at a fair price, when you need money. Conversely, low market liquidity can mean that an asset might take longer to sell, possibly leading to a lower selling price. Now that we understand what market liquidity is, let's move on to how to analyze it in real time. There are several factors that influence market liquidity. Knowing these factors will help us in our real-time analysis. First, let's talk about volume. Volume refers to the number of shares or contracts traded in a security or market during a given period. It is often shown directly below the price chart and, in a way, acts as the heartbeat of the market. When volume is high, there is a lot of activity, which can lead to a more liquid market. Conversely, when volume is low, there might be less interest, resulting in a less liquid market. Secondly, we have time. Time plays a significant role in market liquidity. For example, the most liquid time of the day in the stock market is typically when the market opens and closes. This is when trading volume is at its peak and the market is buzzing with activity. Conversely, during off-peak hours, liquidity can dry up, making it more challenging to buy or sell without impacting the price. Lastly, we have volatility. Volatility refers to the degree of variation of a trading price series over time. High volatility usually means there is a significant amount of uncertainty or risk associated with an investment. This uncertainty can cause investors to hesitate, which can reduce liquidity. On the other hand, low volatility often indicates a stable market, which can boost liquidity as investors feel more confident in their trades. These three factors, volume, time, and volatility, are interconnected and can greatly influence the liquidity of the market. For instance, during times of high volatility, investors might be more cautious, reducing volume and thus liquidity. Or, during off-peak times, both volume and volatility may decrease, leading to lower liquidity. Understanding these factors is the first step in analyzing market liquidity. Next, we will learn how to measure it. Measuring market liquidity is not as complex as it might seem. There are a few key indicators to look out for. These indicators serve as your compass, guiding you through the sea of market transactions and helping you assess the ease and speed with which assets can be bought or sold without impacting their prices. First off, let's talk about the bid-ask spread. This is the difference between the highest price a buyer is willing to pay for an asset and the lowest price a seller is willing to accept. A narrower bid-ask spread signifies a more liquid market, as it indicates that transactions can occur without significant price changes. Conversely, a wider spread can suggest lower liquidity. Next, we have volume. Volume refers to the number of shares or contracts traded in a security or market during a specific period. High trading volume is often associated with higher liquidity since it indicates that more transactions are being made. However, it's essential to consider the size of the market. A high volume in a small market may not necessarily indicate high liquidity. Then comes turnover. Turnover is the rate at which an asset is being bought or sold in the market. High turnover suggests that the asset is highly liquid, as it indicates frequent trading. However, like volume, turnover must also be considered relative to the size of the market. These measurements are not standalone indicators, but they complement each other. They provide a more holistic view of market liquidity. For instance, a market with a narrow bid-ask spread, high volume, and high turnover is likely to be highly liquid. Remember, the goal is to analyze market liquidity in real time. So it's not just about understanding these measurements, but also about being able to monitor them as they change. This is where technology and financial analysis tools come in, But that's a topic for another scene. With these measurements, you are well on your way to analyzing market liquidity in real time. But there's one more thing to learn. Thankfully, there are tools available that can help us analyze market liquidity in real time. When it comes to assessing liquidity, there's no need to go it alone. The financial world has developed several insightful tools that can help us make sense of market liquidity. First, we have the Liquidity Cost Score, or LCS. This tool measures the cost of executing a trade in relation to its size. It takes into account the average bid-ask spread and the volume of trades. The LCS is a brilliant tool for investors, as it helps to quantify the cost of trading and provides a clear picture of the liquidity in a given market. Moving on, we find the volume-weighted average price, or VWAP. This tool gives us the average price a security has traded at throughout the day, based on both volume and price. It's incredibly useful for investors looking to enter or exit the market, as it provides a benchmark that can help determine whether a security is being bought or sold at a good price. Another tool in our arsenal is the Amihud Illiquidity Ratio. This ratio measures price impact per dollar of trading volume. A higher ratio indicates lower market liquidity, while a lower ratio suggests greater liquidity. This tool can be particularly useful for investors interested in less liquid markets, as it helps identify securities that may be more difficult to trade. Finally, we have the Market Liquidity Risk Index, or MLRI. This index measures the risk of a decline in market liquidity. A higher MLRI indicates a higher risk of a liquidity crunch, which can be crucial information for investors looking to avoid potential market pitfalls. With these tools, you are now equipped to analyze market liquidity in real time. By understanding and implementing these tools, you can make more informed investment decisions, navigate the financial markets with greater ease, and ultimately increase your chances of investment success. So dive in, explore these tools, and let them guide your journey in the world of investing. We've covered a lot of ground today. Let's summarize the key points. Firstly, we delved into the concept of market liquidity, which, to put it simply, is the ability of an asset to be quickly bought or sold without causing a significant change in its price. It's the lifeblood of any healthy market, enabling smooth and efficient transactions. It's like the oil that keeps the economic engine running smoothly. We then explored the various factors influencing market liquidity. These include the number of active buyers and sellers, the size of trade orders, and market volatility. Remember, the more participants in a market, the higher its liquidity. Similarly, larger trade orders can impact liquidity by causing price fluctuations. Market volatility, on the other hand, can either enhance or reduce liquidity, depending on the circumstances. Next, we discussed how to measure market liquidity. We learned about the bid-ask spread, which is the difference between the price at which someone is willing to buy an asset and the price at which someone is willing to sell it. A narrower spread indicates higher liquidity. We also talked about the depth of market, which refers to the market's capacity to absorb relatively large market orders without impacting the price of the security. We also touched upon volume and turnover, two other critical indicators of liquidity. High trading volume and turnover mean there's a lot of activity in the market, and thus higher liquidity. Finally, we dove into the tools for analyzing market liquidity in real time. We looked at how real-time data feeds can provide valuable insights into market liquidity at any given moment. We also discussed how advanced analytics tools can help interpret this data, providing a clear picture of the market's liquidity conditions. In conclusion, understanding and analyzing market liquidity is a crucial component of successful trading and investing. It helps in making informed decisions, managing risks, and maximizing returns. Remember, a liquid market is a healthy market, and a healthy market is a profitable one. We hope you found this video informative. Don't forget to subscribe to HouseLux Estate for more insightful content. Until next time, happy investing!